those are available.
Hey everyone, and thank you for joining. Today we're going to be talking with Mike Tizzano with the Tizzano Group in Arizona. And we're going to be talking, do you think we're in a bubble right now? And are you waiting for the market to crash in order to buy a home? So Mike, let's talk about the bubble that people think we're in and the people who are waiting for the market to crash.
Absolutely. Thanks for having me, Erica. And again, my name is Mike Tizzano. I'm with Fairway Independent Mortgage in Arizona. My NMLS ID is 1015837. I have to get all the legalities out of the way, of course.
Yeah.
So anyway, so I was an appraiser back in 2005 when we were in a true housing bubble. And to a lot of people on the outside looking in, and even some real estate agents, this is starting to look a little bit like that because we're starting to see homes go on the market, multiple offers immediately, people offering over asking price. And things like that. And it's starting to scare people. And I talk to clients every now and again that say, I'm just going to wait for it to crash. And we get, number one, we root for a housing market crash because we all saw what happened after that, right? So number two, there's a lot of significant differences between what we were seeing in 2005 and what we're seeing now. And number three is, I'll never say never to anything. You know, if you told me last year I'd be quoting people in the twos on 30-year mortgages, I would have told you you're smoking something and pass it. But you know, and here we are quoting people in the twos, right? So, you know, so I'm not going to say never. We'll never see another crash like that. There's very likely going to be a point, and I don't know when that is, that it's going to slow down. Things are going to level off, and we might see a dip. But if you took a 10% dip from where we're at today versus where we're at 5 years ago, it's still significantly higher than where we were at 5 years ago and even 3 years ago. So, and a 10% dip is really significant and probably not likely. But that's just kind of to illustrate to people, like, if you wait too long, even if you wait for the crash might still be worse. Plus, you're going to be paying rent for all that time, right? A lot of loss, a lot of just paying rent if you don't have to is just throwing money out the window, right?
And another thing too is you may not qualify later on.
Exactly. So I just want to highlight some of the major differences. And one of them is appraisal independence. So back in 2005, when I was an appraiser, I'd have loan officers bugging me all the time. Can you just stretch the value $5,000? Can you just stretch the value $10,000 to make this work, especially on cash out refinance, right? So right now, if I were to do that to an appraiser, I would lose my license. I would not be able to be a loan officer anymore. We order all of our appraisals through appraisal management companies. There's some exceptions to that, but and we are not allowed to discuss the value or anything with the appraiser. If I have an issue with the value, I can request a reconsideration of value through the management company. I have to provide comps that they fail to use, or if, you know, because I have appraisal experience, if I can review and say your adjustments are off, or, you know, why didn't you give more weight to a comp? That's all I can do. But I can't pressure an appraiser into increasing value to make my cash out refinance work. Okay, so that's number one. Number two, and probably the second most important thing I'm going to talk about, is the lending guidelines. I mean, since 2008, 2008, after everything crashed, they just choked lending and made it almost impossible. And they've loosened up a little bit. And I always say it this way: there's enough regulation to make my job annoying, and that's perfect. Okay, it's not like there's so much regulation that we can't get stuff done, but there's not like there is so little regulation that people are just running wild. Like some examples in 2005, they had stated income loans, literally called in the business liar loans. Like, hey, just say you make 50 grand a year. Well, I only make 20. Yeah, that doesn't matter. Okay. You also had a big push for adjustable rate and interest-only mortgages back then. So we don't have a lot of adjustable rates and interest-only mortgages going on now. So like for my own example, I was in an ARM on my own house because I didn't understand it that well back then. And my payment went from $1,100 to $1,500 a month in 1 month, right? That's shocking to a lot of people. So now if somebody wants to take an adjustable rate mortgage, we don't qualify them on the introductory rate. We qualify them on the adjusted rate. So even if they want to take that, they have to be able to qualify for the higher payment. It's just things like that. We have to verify that they have the ability to repay their loan. We have to verify their income. We have to verify their assets. In the refinance world, you cannot cash out 100% of your equity anymore. In fact, back then, there were some banks and places letting you cash out 125% of your equity, which is
so
ridiculous,
crazy.
right? So, okay, I'm upside down. I'm walking away from the house. So why did we have a foreclosure crisis? Oh my God, everything's slowed down. I'm upside down. I'm leaving. So, back then you had investors buying houses, literally doing nothing to them and selling them 30 days later for $20,000 more. Now the only flippers you have are actually rehabbing houses and actually approving them and then selling them. And there's rules in place if you're using government financing that the owner has to own the house for at least 90 days or 91 days before you can purchase it if you're using that kind of financing. So you can't just go in and do what they were doing back then. So that's really the biggest things on the lending side. And then the other thing we were discussing is affordability. Right now, you think of it, in Vegas and Arizona, we've seen 7 and 8% increases in housing prices year over year.
Mm-hmm.
But because interest rates have dropped so far, the affordability index actually went up by 10%, which means homes are 1.5 to 3% more affordable than they were last year, even at these higher prices. So the people that are purchasing these homes can actually afford them and will be able to continue to afford them because we have to verify that.
Mm-hmm.
Obviously, things can happen in people's lives and things get hurt. And we've obviously seen that this year with COVID. But think about what happened with COVID. And this is probably the most important part of it. 2007, 2008 is still fresh in everybody's mind because that was the last downturn we've had, right?
Mm-hmm.
Nothing good happened during that time. And you think anybody in government, whether it's the president, Congress, local governments, ever want to see that again while it's on their watch?
Absolutely not.
Right. So what happened when COVID hit, right? A bunch of people got laid off because they had to close a bunch of things, a bunch of different industries. And people were freaking out because, oh my God, 30 million people are going to be out of jobs. The housing market's going to be screwed. Well, there's two things about that. Number one, the demographics of people that were in the type of jobs that got impacted the most were typically not home buyers because you had your gig workers, tipped employees, things of that nature that are generally not your home buying demographic to begin with. But also, the first thing the government did was shore up the housing market. The first thing they did was put a moratorium on evictions. They went ahead and allowed for automatic forbearance on your house. And then they changed the forbearance rules. It used to be like if you went to because when they first said the automatic forbearance, those of us that are in the mortgage business don't
12
do
months. Absolutely.
Right. And then all of a sudden, about a few weeks later, they came out and said, okay, this is what the rules were going to change. Because it used to be with a forbearance. Yeah, exactly. Because it used to be with a forbearance is, okay, I take a 6-month forbearance on month 7. All of a sudden, I have to make those 6 payments like right now. Like, who can do that? That's the dumbest thing ever. So they said, okay, well, if at the end of the forbearance, you now are back to work or you have income coming in, we're going to give you options to take care of your forbearance. And not only that, instead of having to wait a year to do a refinance after a forbearance, as long as you've met your whatever option you've done, the best option was to just put it on the back of the loan because then it's considered a taken care of forbearance payment. Or you might have to pay 3 months before you do it. You can refinance and take advantage of these great rates and drop your payment.
Interest. Yeah.
Yeah. So all this stuff just points to the fact that anytime we have any kind of an issue, the government understands that the real foundation of our economy is the housing market, and they are not going to let it crash again.
And also, too, a lot of these homeowners have equity in their home that gives them the ability to do that and refinance.
Absolutely. And we're not just letting them access that equity to go buy boats and, take fishing trips and stuff, unless they have a defined ability to repay that back, they can't just do it. Or if they're out of work, we just work with them on that end of it. But put it this way, banks we're not real estate companies, right? We don't want to own houses. Chase and Wells Fargo don't want to own houses. Fannie and Freddie. I used to work in loss mitigation, and Fannie Mae used to come into our office, weekly. And I'll never forget the one time she said, there are entire condo projects in Florida that we own. Every unit in the project. They don't want to do that again. So they're going to do everything possible to make sure that we don't have a repeat of 2007, 2008.
Yeah, great information. And also too, the statistics are showing something different. You know, I know a lot of people were in fear of what's going to happen, but like maybe March and April, we did see a little bit of a drop, maybe houses not selling as much. And I think a lot of people were scared. But after that, I mean, we seen it, you know, that spring market come in the summer. So everybody who usually buys in the spring came in the summer and bought. So our inventory here is only 1.6 months.
Yeah.
And our median price range is 350,000.
The only thing that can really ruin everything is panic. Like if people start seeing, okay, we're leveling off, oh my God, here comes it's not coming. So I always suggest just turning off the news, because they're mainly full of crap when it comes to stuff like this, and just talk to people like Erica that you trust, that have the information, and get actual real data and information. And you know, myself included, if we see something coming that's like, this is not good, you'll know. You know, you won't have to guess. So, but honestly, we can't continue to go up at the pace we're going up for much longer. But that doesn't mean we're going to come right back down. It's not one of those situations. And another interesting thing is actually from Comfort Report. If you look at the line of appreciation from 2000 through 2019, it was at the end of 2019, through all the ups and downs and those two major dips we've had, and now three major dips. If you look at it, our housing prices in Phoenix, and I believe it's the same in Las Vegas, are exactly where they should be, following a 3% annual appreciation, average appreciation from 2000 to 2019. So yeah, even through all those swings, we're right back where we're supposed to be. So it's not like we're back 10% higher than we would normally be.
Yeah, and there were years where appreciations, I mean, you were seeing 10, 12% here in Vegas. Now we're about more at the average. And also too, Mike, that you were talking about like the numbers, and also don't be surprised, we're hitting the end of the year, and that's where we tend to get a little bit slower in the market. So please consider that is normal, and that shows like on the statistics, if you guys could see it, that it is normal. See how we, you know, go up in the summer and then it comes down towards the end of the year. And that's typical. So these are our statistics. And then on the bottom here, if you just like Mike was talking about, so this goes from 2013 and it's showing an increase to 2020. You could see it, of the median price.
Even the end of the year thing, people don't want to move toward the end of the year, but I have a feeling this year is going to be a little different. I don't know that it's necessarily going to slow down on the purchase side, you know, but we'll see what happens. But I mean, you know, my October is already set up to be my best month ever, as far as
the year.
Yeah, it's not typical. Typically, you know, those things happen in March, April, May. So this year is different all around, not just in the housing market, but definitely, you know, I just wanted to do this video with you to put your clients at ease, you know, that might be afraid that we're looking at a repeat, just because from the outside looking in, it does look a lot like 2005, 2006, but there's so many key differences that are pointing to I'll never say never. We're not likely to see that anytime soon. So.
Yeah. And I think too that there'll be signs. And I also think too, one great advantage for buyers right now is that interest rate is so low that they could afford more now for their family. And you are seeing a lot of people coming together, multi-generation homes they're looking for, you know, so that multiple people could live in the house. So we're seeing a lot of changes happening, and real estate is still continuing to happen, whether they're upgrading, downgrading, or deciding to cash out.
Yeah. You know, and an absolute great example of what you were just talking about, I had a client that I pre-qualified at the beginning of the year, and she qualified for a lot more than she was comfortable paying. But for her comfortable payment, I was qualifying her at about 310,000 just the other day. I was like, well, you can get that same payment for 375 right now because of where the rates were compared to where they were at the beginning of the year.
Wow, that's a huge difference. And that could get them a lot more. It is really a great time. If you could afford to purchase a home, it's a great time.
Just be prepared to have your heart broken a little bit when you miss out on offers here and there. But, you know,
Yeah.
there's always going to be those California cash buyers. But, you know, but there's definitely ways we can always help you get your you know, strengthen your offer and make sure that you're getting accepted. And, you know, when I'm licensed out there and we're working together, I'll share those with you. So
Sounds good. And so if any of you guys have any questions, me and Mike are here for you to help you through the buying, selling process, or give you some market updates. So thank you for watching, and catch us in the next video.
bye, everybody.
Bye.